This chart shows Zomato's stock price trajectory from early 2023 to early 2025. After a severe post-IPO crash, the asset rallied to historic highs. To understand why a historically cash-burning platform commands this valuation, we have to look past the top-line numbers. Zomato has transitioned into a holding company, and the ticker reflects the market pricing in this new corporate structure. This document outlines the vision statements for the 5 distinct brands operating under the Eternal umbrella. Alongside the legacy Zomato app, the portfolio now includes the quick commerce platform Blinkit, a going-out app called District, the B2B supply chain Hyperpure, and the Feeding India initiative. If you evaluate this entire portfolio strictly on consolidated earnings, the EV to EBITDA multiple sits well into the hundreds. By traditional metrics, the company appears overvalued. Evaluating Eternal strictly as a restaurant delivery business misses the mechanism driving the stock. The actual engine supporting this valuation is an inventory-led logistical model operating beneath the surface. The new core business relies on fulfilling physical orders in under 10 minutes. The bullish investment thesis argues that Eternal is capturing the grocery market, accessing a segment with significantly higher order frequency and volume than restaurant delivery. Through the acquisition of Blinkit, the company currently holds a dominant 46% share of gross merchandise value in the quick commerce sector. The bearish counter-argument points to the extreme capital required to maintain that lead. Quick commerce is a cash-burning operation. Rivals like Zepto and Swiggy Instamart are heavily funded and fiercely competitive. The validity of Eternal's market cap rests on whether buying Blinkit was a defensive move for a stalling food app or the strategic pivot required to secure long-term terminal value. We start by isolating the legacy food delivery segment. This is now a mature, cash-generating operation. To protect margins against fluctuating order volumes, the company recently implemented platform fee hikes of 17 to 19%. Contrast that with Blinkit. This is an inventory-led model built on a network of localized warehouses known as dark stores. This infrastructure serves as the company's primary growth engine. To supply those dark stores, the company relies on Hyperpure. Originally designed as an ingredient supplier for restaurant partners, it has evolved into the critical supply chain backbone for the entire organization. When Hyperpure began sourcing directly for Blinkit's grocery inventory, its revenue quadrupled. This internal supply chain creates a logistical advantage over competitors who rely on third-party wholesalers. Adding optionality to this portfolio is the new District app, a dedicated platform for booking dining, movies, and live events. This targets discretionary spending. Mapping the cash flow reveals the underlying architecture. The mature profits generated by food delivery are routed directly to fund the expansion of Blinkit and District. Meanwhile, Hyperpure provides the physical logistics layer that makes Blinkit's rapid delivery possible. Zomato functions as an integrated supply chain machine, where one division finances the capital expenditure of the next. To accurately track the output of this machine, management transitioned its primary metric from gross order value to net order value. This adjustment provides a clearer picture of actual platform revenue by accounting for India's retail price laws. In the March 2025 financial summary, adjusted revenue grew 60% year-over-year, yet adjusted EBITDA dropped 15%. The notes isolate the cause, a bottom-line decline driven by accelerated dark store expansion. Blinkit added 294 net new stores, targeting 2,000 locations by December 2025. We can observe a profitability seesaw. Margins in the legacy food delivery business are steadily improving, currently sitting at 5.2% of net order value. But those profits are immediately drained at the consolidated level. Cash flow generated by restaurant deliveries is being actively deployed to subsidize the heavy capital expenditure required to build out Blinkit's physical footprint. Management is suppressing near-term profitability to execute a quick commerce land grab, attempting to establish a physical network before their competitors can scale. Once that physical network is established, a high density of users and localized warehouses creates a structural barrier to entry for competitors. By cross-pollinating users between the food delivery app and Blinkit and utilizing a shared delivery fleet, the company lowers its customer acquisition cost. Gaining a grocery customer requires less marketing spend if they already use the food app. This efficiency is visible in the working capital metrics. In the years following the Blinkit acquisition, Working capital improved from negative figures, turning positive to 60 crore rupees by fiscal year 2025. However, the income statement reveals a drag from employee stock ownership plans. A recent allotment of 477 million shares creates a significant non-cash expense that depresses reported accounting profits. Because these ESOP charges affect the bottom line without impacting cash reserves, operating cash flow provides a more accurate measure of the company's capital generation. The footnotes also expose substantial contingent liabilities. The company is facing GST demand notices totaling over 420 crore rupees regarding taxes on delivery charges. Alongside tax disputes, filings note impairment charges from shuttered fintech and delivery subsidiaries, indicating past capital allocation experiments that failed to yield returns. While the underlying unit economics of core operations are improving, aggressive accounting and regulatory disputes mean investors are paying for high execution. Because of heavy physical expansion, applying a standard price-to-earnings ratio is an ineffective metric. Instead, analysts use a sum-of-the-parts valuation. This separates the mature cash cow from growth divisions. Institutional models value the established food delivery segment at 45 times projected 2028 EV to EBITDA. Conversely, Blinkit trades at 1.5 times projected 2028 net order value. The market is not valuing the cash Eternal earns today. Investors are paying a premium now for the assumption that this company will achieve its terminal state as a dominant digital marketplace. Reaching that valuation requires steady execution over the next several years. Management must successfully deploy 2,000 dark stores, expand Hyperpure's operating margins, and scale the newly launched District app into a $3 billion business. The integrated supply chain and infrastructure moat offer high growth. Food delivery generates cash, but current pricing demands near-perfect performance, leaving minimal error margin. Zomato has built an integrated logistics network for the instant economy. While the business model is resilient, current stock valuations require near-perfect execution to satisfy investors.